Hello, welcome to Bitcoin Not Crypto. I'm Forrest Total, and today I'm joined by Dan Hillery, who is part of the True North crew. We're going to talk about MSTR, about Strife, Stride, these new perpetual preferred offerings that MSTR has, and hopefully answer a bunch of questions that you might have, and kind of figure out what these products are, who they're for, and so on. So yeah, Dan, thanks for hopping on the show, and we'll get into that right off the bat. Actually, before that, maybe a little bit about who you are, what your story is, just for anybody who hasn't heard that before. What got you into MSTR? What got you into Bitcoin? And yeah, what is your story a little bit?
Sure. My background's in engineering. I studied to be my undergraduate degree was in electrical engineering, and then I'm currently a master's student in electrical engineering. And what got me into Bitcoin was I'd always been interested kind of in financial freedom and the idea of investing, compound interest. A bunch of different books led me down that route. And I think most people, just when you're a young guy, you look at money, you look at the world, you try to figure out how to position yourself. I found Bitcoin in 2022, and obviously that kind of changed my life. I'd been investing since I was very, very young, working in index funds. And index funds were always very, very attractive to me from a very young age until I found Bitcoin. And then my thesis around Bitcoin is kind of an S&P 500 for the future. So it made a lot of sense for me to move there. And then MSTR, ultimately, I started to understand through the options market. And I had been studying quantitative finance throughout college and studying a lot of different kind of options, trading strategies, automating strategies, things like that. And the options market was very, very interesting with regards to Bitcoin and MSTR. And at the time, the only real options market in the US was on MSTR. There was no IBIT options. There were no other Bitcoin treasury companies. And I didn't have access to Deribit or any sort of other foreign exchanges for direct Bitcoin options exposure. And so that's kind of led me into MSTR and understanding the value of that equity.
Makes sense. Okay, so that's what's I found interesting there was when you were starting out with investing, you were interested in these index funds, which I think is a similar case for a lot of people. And I think a lot of that is because they see that as like pretty safe, low risk, and you're getting like an average, 8 to 12% per year if it's just the S&P index, for instance, something like that, right? But then you went to Bitcoin, which I think us as Bitcoiners and interested in leverage Bitcoin equities, these kind of things, we kind of see Bitcoin as like that safe asset now, which is crazy to a lot of TradFi people. But you went all the way out to MSTR and even beyond that on the risk curve to options. What was that like? Why did you go from indexes to all the way out on the risk curve to options? Like what led you down that sort of what some people would see as out further out on the risk curve?
Yeah, I mean, I think a lot of it comes down to understanding what you know. I know Buffett talks about that a lot. And for me, I don't know, I kind of understood Bitcoin and I understood probabilities. A lot of kind of an engineering education is about breaking things down to first principles and kind of building a rigorous mental framework around different problems. And so I spent a lot of time studying kind of like Bitcoin and MSTR's behavior as an equity. And it seemed to me that the options just weren't quite priced correctly, unlike other assets. And so the thing I always said was like, how do you price a Bitcoin option in decaying fiat, right? If you believe Bitcoin's going up at 30% annually, there's absolutely no way to price a Bitcoin option or a leap. When I say options, I mean long dated options. You can't price a 5 year leap. Leap is I think it's a long expiration something option. It's just a long dated call option, and you can't price a long dated call option on Bitcoin in a currency that's losing value relative to a different currency, right? And so that's like a fundamental mismatch. And so for me, I don't trade options on any other equity because I just don't think there's as much of an edge. Whereas here, if you know the direction of the underlying asset, you can make better, higher probabilistic trades. And so that's what I think the reason. Yeah. So to answer your question, the reason options were interesting to me is because they're the one way to express a leveraged bet on Bitcoin without the liquidation risk of perpetuals. And if you want to be levered long Bitcoin, I think options are one of the best ways to do that.
Yeah, and it sounds like you're still in that camp because there's a lot of people now that have figured out or have started to figure out the MSTR trade or play or position, right? And even beyond that, now they're thinking, okay, we'll go into some of these smaller plays. We'll buy some Meta Planet, Nakamoto, whatever, right? And that's how they're playing. Again, to go out on that risk curve, the potential growth of these smaller cap plays. But it sounds like you're still in the camp of thinking that it's still very hard to price these leaps on something like MSTR properly because nothing's really fundamentally changed there. You're still pricing something in decaying fiat, as you put it, but it's backed by Bitcoin. Is that kind of still your thought process there, or was that more of when you got into the trades with options?
Yeah, that's a really good question. I mean, completely right, because now the game's changed because of IBIT options. So when you buy IBIT options, you essentially strip out the counterparty risk and um, the fluctuation of the multiple. So I think the hurdle rate for leveraged Bitcoin equities has become 3-year IBIT options, and people don't really ever talk about IBIT options in that sense, or maybe the lever like it's either 3-year IBIT options or uh, it's 50% margin IBIT. So like there's just a lot of different ways you now can access leverage in the Bitcoin ecosystem as it's been financialized. And so people are quick to jump out into these smaller equities, looking at the historic Bitcoin per share growth and then projecting it forward. And I think you have to benchmark that not against Bitcoin. Because a lot of people say, well, Bitcoin's only going to go up 30% a year. Like that's not going to get me my 10x. Yeah, but you can lever that in a way or bet on that 30% a year in ways that are more certain than a smaller LBE. And then finally, I wanted to make the point of I know a lot of people, like when I was in Bitcoin, a lot of people are trading like altcoins at the time, even 23, 24, people were still trading altcoins. And I always believe that I've always rather take a leverage bet on what I believe to be a sure thing than take a speculative bet on something with a bigger percentage of my portfolio. Then take a smaller percentage of my portfolio and bet on something that I really don't know the actual independent variables on. And so I think a lot of people miss that calculation. They think, well, this is only 10% of my portfolio. I'll put it on this gamble. But if 1 out of 20 times that hits, and the payoff. So it's like an expected value calculation, right? If 1 out of 20 times that hits, but that one time it hits, it's I don't know, it's a 5x. That's still not a positive expected value trade, um, right? Whereas if you're buying, if you have levered non-liquidation risk exposure to Bitcoin, I believe that's an extremely high expected value trade over a long period of time.
Right, and yeah, and you've mentioned there about structuring that for yourself in a way that um, provides some risk management. Like you talked about not using perpetuals and or I think it's perpetuals, right? The perps that people use on like these trading platforms, crypto trading platforms, where you can get liquidated at certain prices, and you're kind of out of your position. Whereas with options, you're really more speculating on sort of like a time value. Um, and of course you could go all the way down, but really it's on you to like exit that position or to trade or do something there. But
It's all just leverage, right? And you're trying to look at the market and figure out what is the lowest risk form of leverage you want to take. And for a corporation, maybe that's taking 30-year fixed term debt. For an individual, maybe that's buying options or using leverage in a different way. So yeah, exactly.
right, right. So one thing I haven't really heard you talk too much about, maybe I've just missed it, but what are your thoughts on these new emergence of every other day another Bitcoin treasury company? Is there some sort of copycat risk going on to say MSTR? Like we've seen MSTR trade a little sideways. People are speculating maybe why that is, all sorts of different potential reasons. Maybe it's just a beach ball under the water, right? Maybe it's about to pop. Is it potentially from copycats coming into this field, or do you see these as potential plays to hold for any period of time? Are you interested in the Bitcoin treasury companies that are out there besides MSDR?
I just think about these things theoretically and then like allow people to make their own decisions. And I post my portfolio a lot so people know like, what I'm up to. But um, The idea of an MNAV being the forward-looking expectation for Bitcoin yield is kind of how people are trying to price these treasuries. But it's a forward expectation of Bitcoin yield. So you're making a lot of assumptions. And a lot of people look into the prior amounts of Bitcoin yield for a corporation and then project that forward on some sort of curve. And they call it days to cover MNAV. And I don't think that's actually a super accurate way to value the metric, because equities themselves are forward looking, right? They look out forward maybe 5, 10, 15 years. And so, equities are priced based on future cash flows. That's just how they are. So how do you price out a new, reverse merger SPAC freaking Bitcoin treasury that's been around for 3 weeks? How do you price forward 10 years the Bitcoin yield on that and justify it? And I think they obviously shouldn't be. So again, that's higher risk, right? Obviously, if they're lower in their ramp up cycle for Bitcoin per share, you can acquire more Bitcoin. But the really interesting part about that is, one, people think, oh, if the company's smaller, they can just acquire more Bitcoin per share at a quicker rate. It's really a function of demand for the equity. So the Bitcoin, like all these, most of these use some form of ATM, whether that be a moving strike warrant or it's share issuance or just private investment deals, where they offer shares to private investors on like a secondary market. And so it's all a function of issuing equity to buy Bitcoin at the beginning for that ramp up phase. And that's a function of the demand for the equity. And what people aren't getting is, like, if you sell, not what people aren't getting, but the way I think about it sometimes is like, even if you're really small, if you're trading at a 3 MNAV and you sell a certain amount of that equity and then use it to buy Bitcoin, that's actually the same Bitcoin yield as a company that's 4x as big with the same trading at the same MNAV, as long as there's demand for those two equities. Right now, the reason those small companies have such Bitcoin yield is because there's so much demand in the market for these small market caps that they can issue a ton of shares and have massive amounts of yield. If Strategy were to issue the same magnitude of shares, even though their ATM is just as accretive as a smaller 2x MNAV company, their share price would get hammered. So they can't issue that. So it's all a function of demand for the equity. My point being is, when the demand dries up for a small leverage Bitcoin equity, it doesn't matter that they're small. They won't have as rapid a Bitcoin yield.
Right. So it's liquidity in the market, or demand for the shares is kind of how you put it there. Which to me kind of reinforces this idea that I've started playing with, that, and I'm not alone here, but that MSTR has a moat in a few different places. And to me, it seems like the liquidity that they have within the market, the interest in their options, in their shares, that has a lot of staying power. And even if these other entrants can ramp up quicker because of temporary demand for their shares, it's really unknown whether that's going to be have the same amount or like similar size liquidity for a long time as MSTR continues to have.
Totally. Yeah, that's a really good way to put it. And I think part of it, and I was actually getting really nervous with Strategy for a while this winter, and I'll be quite frank in saying that. And it was Stride that made a flip for me. But if the shorts get a hold of your stock, and I think a lot of Bitcoiners are they're very idyllic about kind of, everyone's just here to make money and it's all a cooperative system. There's guys on Wall Street with $1 billion in their pocket looking to short the bejesus out of your stock, and then, make the secured debt holders meet the liquidation criterion, and then they'll steal the Bitcoin. So like that stuff's happening. And so I think, like, one of these equities, and the thing that's really scary about kind of just any Bitcoin equity, Strategy included, is as that multiple expands, if the primary way you acquire Bitcoin per share is through equity issuance, as that multiple compresses, that ATM becomes less effective in a Bitcoin per share yield sense. So as you short it and the MNAV compresses, the yield also decreases, which justifies an even lower MNAV. So it's a cyclical cycle down as that MNAV compresses, right? And so when a big short gets in the game, they can really drive that MNAV down and keep it there. They can completely keep it there. And so my point being is, if you don't have a defense mechanism against that, then you don't have a lot of hope. And those defense mechanisms are, one, a non-cumulative dividend preferred stock, a la Stride, or an operating business that generates cash flow where you can continue yielding Bitcoin per share and stacking that on the balance sheet. That will fight off the shorts because people will see the value in that non-ATM Bitcoin yield.
So it's something besides the ATM that that makes it basically makes there a reason to have a premium to MNAV to the holdings of Bitcoin. So you said there the non-cumulative dividend preferred share, which is Stride. So why is it important for it to be non-cumulative? Why was Stride the one that really switched your mind there? Is it because they can hit that instead and acquire Bitcoin, pushing up the Bitcoin they have without immediate dilution or need to hit ATM on common? Like, sort of, can you explain why Stride was a significant turning point for you?
So the reason is the defense against the shorts, right? So the shorts, if the shorts are coming in and piling on the stock, so what they do is they borrow the shares and sell them into the market, which creates a lot of sell pressure and the stock falls. If they get it to 1 MNAV, they can really hold it there. They can really, really hold it there and even take the equity price below the net asset value of the corporation, while the corporation is completely helpless because they can't issue equity and have Bitcoin yield in the way they have before. So the shorts push them down, and then they trade below par, right? They trade below 1 MNAV. What do you do? What does a company do? Well, a lot of people have stated, oh, you can sell Bitcoin and buy back your shares. And that's like reverse Bitcoin yield. It's an arbitrage in the reverse direction. But you can't do that. If you're selling Bitcoin, everyone's going to dump your stock. It's a complete disaster. There's taxes associated with that. There's legal framework surrounding that. So that's a complete disaster. What do? You have to buy back your stock at that point. If it trades at a discount, you have to buy it back. And so what Strategy now is able to do with Stride is they're able to issue that preferred, which is a 10K asset, and buy back their equity. Then you say, why can't they just do that with Strife? And the reason they can't do that with Strife or Strike is because Strife and Strike are these highly creditworthy instruments. And for those instruments and for Strategy to remain creditworthy, they can't really exceed a 30% debt ratio, right? So between the converts, Strife, and Strike, they're in that order in the capital structure. They shouldn't, to keep the creditworthiness of all those instruments and of the corporation, since those dividends compound against Strategy's hands are tied, essentially. They have to pay the Strife and Strike dividend under any circumstance, right? Like they have to sell Bitcoin to pay those dividends if it comes to that. So they have to manage that leverage ratio because they're liabilities. Now, with Stride, since those dividends are non-cumulative, they can increase the leverage ratio from 30% up to 50% if need be. And the key there is it would probably be during a bear market where the Bitcoin price has fallen that the shorts would be able to push the price of the equity down below NAV. That increases the leverage ratio of Strike, Strife, and the converts, right? So if the converts, Strike, Strife were 30% leverage ratio, Bitcoin falls by 50%. They're now 60% leverage ratio between convert, Strike, and Strife. They couldn't, in good faith, issue more of those products to buy back their stock. They can issue Stride in such a scenario to buy back their stock and force the shorts out from below 1 MNAV. And I think that's really important. You can only do that with a junk bond.
Okay, so I want to get a little more clarity on that of why Stride, and so they can do it with the junk bond because it's a junk bond, because it's not, when they issue more of, say, Strife and Strike, it's it's adding more leverage to those products, which the market is essentially demanding uh, less leverage or more collateralized on those products. Is that kind of the idea? But with Stride, but doesn't the leverage, wouldn't adding more Stride also increase the leverage on MSTR as a whole and affect Strike and Strife as well? Wouldn't that?
It would affect the common stockholders. So since Stride is below Strife and STRK, it's right converts, Strife, Strike, Stride. When they go out and issue Stride, it increases the leverage that is represented by the common stockholders. So the leverage package you get as a common stockholder increases when Stride is issued. So that might be nerve-wracking for a common stock holder, right? But for both the Strife and Strike and convertible note holders, they now actually have more cushion below them because Stride was issued to buy more Bitcoin. And so it's all about the positioning, the credit worth in the capital stack. Since Stride is below those two products, their credit worthiness is preserved and maintained. However, as more and more Stride is issued, it technically becomes less credit worthy. But since this is a last resort scenario, it's fine if Stride's yielding 12, 13%. It doesn't matter as long as it preserves the creditworthiness of the senior instruments.
And oh wow, okay, so it actually increases as they use it more. It increases the credit worthiness because they're able to either buy Bitcoin, as you said, or in a negative MNAV situation, actually buy stock back because it's more accretive and will help with shorts that are on the or help defend against the shorts that are on there, and increase the credit worthiness of the higher up on the capital stack products that they have. Wow, that's so interesting. Like, that is, it seems to me like, when a company like this only has the ATM usage, which is what a lot of these early stage Bitcoin treasury companies had. I even remember hearing Jack Mallers, who's the CEO of 21 Capital, talk about how they're not even public yet, and when they become public, their first product is their equity. I think he said that like you know almost word for word. But to me, it seems like that's when you only have the ATM, it puts you in that really vulnerable situation where you sort of need the ability to like have multiple ways of acquiring Bitcoin, and it adds more stability. It's like that decentralization. It's like having a tripod instead of a monopod. It's more stable, right? It seems to me like strategy sits above the others as well because of the added stability that they now have.
Yeah, I think your point is well received. I mean, the way I've been thinking about it a lot is the sustainability of the Bitcoin yield. If all your Bitcoin yields ATM, that demand could dry up for your equity and you're out of luck. Whereas with these perpetual products, as long as you think the Bitcoin held on the balance sheet will continue to expand in value, you can continue issuing, U.S. denominated fixed income products with the Bitcoin as collateral, and that's exactly what the preferred instruments are. So they have a very, very sustainable Bitcoin yield model. Obviously, it's not as high as some of these other, crazy companies, but in a bear market, in sidewards chop, in any environment, when there's no demand for MSTR common, they can yield Bitcoin maybe at a modest 15% annually. They've put forward guidance of 15% annually plus. But I think that's really, really valuable for a shareholder perspective in terms of the durability of their Bitcoin yield.
Yeah. Okay. So I want to get into Stride and Strike, but maybe a little side tangent here. Sailors also talked about kind of breaking into potentially equity markets, I guess, or maybe even debt markets of other countries, other regions. Have you put much thought there? What do you think is a good move for them to do with that? Would it be to issue a preferred in some other country that's accessible by other citizens, or maybe just have MSTR in other regions? Like, what would the move be there? Have you thought about that?
Yeah, I've thought about it. I mean, I don't know all the um, like the legal framework around issuing securities in other countries like that, so I can't speak on it that highly. But if they were to issue a junk bond at 3% in Japan, I mean, they'd sell out day one and then they continue selling out. So it's like if they're able to pull something like that off, they've opened up an unlimited spigot to capital, and they could lever up 100% using that, which they probably wouldn't, but they could. And maybe it's like a Stride. Maybe Stride is that, like, I've always thought kind of Stride is that product. I don't know if they can offer Stride over the counter in Japan or denominated in yen or however they do it, but or any of these capital markets. But I think Metaplanet, obviously they're probably going to try to unlock the preferreds over there, and that'll be a absolute home run and a half. So
Yeah, I imagine that would be a huge unlock. Yeah, so let's move up the capital stack a little bit here. Strike to me is their most interesting from a retail perspective, and from a personal perspective, it would be out of the preferreds. It would be something that I would want to own because it has the fiat dividend income that also self repairs. Maybe we could talk about that a little bit more, because it's an effective yield, sort of the balancer, and then it has potential upside with this convertible sort of piece of it, and the way that I've thought about it, and I really want to get your thoughts on this, is if it was to trade above the conversion price, say the common stock, so it's a 10 to 1 ratio. So say the common stock goes to $1,000 and you were holding strike, there would there not be any reason, would it not make sense for MSTR to not do ATM on strike anymore? Like it wouldn't be accretive for them to, at that point. They would have to issue some sort of new strike type thing with a further out. Um, and then what I'm seeing, what I'm kind of trying to get there is, would strike trade as if it is like the common stock, but also have higher up on the capital stack and paying out that dividend as well? Or how do you see that? How do you see it trading when it gets closer to its conversion price?
It should be trading at a premium to its conversion value of MSTR. Um, because of the bond portion of it, right? Because of the coupon payment. So whether that be a small premium or a large premium, but the ATM will still be accretive and more so than common equity. So common equity is the floor for ATM issuance in terms of accretiveness. It's the least accretive way they can acquire Bitcoin per share, and Strike is second to that. So there's a good slide in the Q1 earnings presentation that gives the exact strike yield per ATM issuance at different MNAVs and different strike prices, and that's a pretty that's a good one. I'll have to bring that back up. But in terms of strike ownership, I think an interesting part. Well, yeah, I'll stop there on this question. So I think they will still issue ATM at 1,000 share at 1,000 plus. But the thing is as we talked about earlier, the leverage ratio caps the amount of ATM they're able to do on strike and keep the company in good faith, right? So if they're at a 25% leverage ratio, they can no longer issue strike ATM.
Okay, so that's more of the limiting factor in your opinion. Okay, and how do you value it with that convertible piece? Do you think, yeah, how do you see Strike as like a retail investor? Is that something that is interesting to you, and why would it be interesting?
Yeah, I hold a lot of it. The reason I do so is because right now, I think it depends. The price, it's like any security, right? The price depends whether it's cheap or overpriced. I think Strike is extremely underpriced. I think it's very cheap. And the reason I think it's cheap is because the way I look at it is you have the conversion feature and you have the bond feature, right? It's trading at $105 today or something. And you get the way it works, and the way I keep it simple in my head is MSTR is trading at what, 390 or 385 today. So 390, yeah, pretty good day actually. Um, you have $39 worth of MSTR exposure in your $105 of strike because of the 10 to 1 conversion. And obviously, you can't convert early, you can't convert before $1,000 a share. But the best way to think about it is $39 of exposure to MSTR, which is roughly 40% of the value of strike, and the rest is a cash on cash dividend. So if you think about it like that, you get 40% of MSTR exposure, and then you get a 12.5% dividend on the rest of the cash you hold with strike. And then on top of that, you get the preference in the capital stack, and then the $100 liquidation preference. And if you're looking at this from a risk adjusted basis, or how that plays out, then the liquidation preference is actually a very important clause. And for big institutions and big money managers, that really matters. That really, really matters. So it adds to the value of the product. So that's how I like to think about it.
Nice, right? Okay, and yeah, maybe just in your own words, would you be able to explain the way that the effective yield works and why these instruments? I think this goes for Strike, Strife, and Stride because they're kind of income based, bond like issuance, where when the price goes to a certain level, that's going to draw out more buyers just because of the yield component of these instruments. Is that the way to think about that, you think?
Yeah, exactly. Bond pricing is pretty interesting. And I know a lot of Bitcoin, like I was a Bitcoiner. I didn't think I'd be like messing around with bonds. So it's very unfamiliar to a lot of people. And the way it works is, so in the case of these preferreds, there's a fixed coupon. So Strike, for example, has an $8 fixed coupon, and the liquidation preference is $100. So in the case of Strategy winding up being dissolved, you're entitled to $100 of essentially their assets, their Bitcoin, before anyone lower in the capital stack gets paid out. So that's kind of what you're guaranteed. Guarantee is a strong word for that, but what you're guaranteed is $100. And you get on that $100 liquidation preference $8 per year in dividends. Now, what that means is if the price of Strike, so at one point it was trading at $80, If it trades down to $80, your effective yield on that product will be 10%, because $8, you still get that $8 annualized yield. And if the principal is $80, then you're getting again a 10% yield on that principal. And so the principal changes and fluctuates. If the principal were to go and increase to $160, you'd be getting a 4% yield, right? And excuse me, is that math right? I don't even think it's right. Yeah, $200, you get a 4% yield. So yeah, so that's the way it works. The coupon payments are fixed, the principal ebbs and flows, and that's how you get the pricing. So yes, and so the point being is if the price of Strike goes down, the yield goes up. If Strike were to get chopped in half tomorrow, you would be getting a 16% yield with the conversion option on MSTR. And I think the market participants would rush in and scoop that up to lower the effective yield. That's kind of how these things work. The guarantee of the coupon payment is what makes this bond floor in the equity based on external interest rates.
Yeah, makes sense. So you said you're personally have some strike. Is it for the dividend payment? Is it for the or like the connection to the equity that like 39% you said basically connected to it currently? What is it about that instrument that makes you interested in holding it?
One, I don't like to lever my MSTR, but I do lever my MSTR with Strike. The reason is because of that bond floor allows it to be a lot less volatile to the downside while giving you essentially free upside, the way I look at it. But the real reason I hold it is because I think it will actually perform. It could perform on par with MSTR up to 650, 700, $800 a share. That's because you get kind of a one-time ramp up period where people realize that strategy is a creditworthy company, and these securities are over collateralized in a way that really no other preferred equity is in the market, and the market's not pricing that in. So that's what you call a credit spread. And credit spread is just a fancy term for the difference in the yield of a certain bond or fixed income instrument, and the risk-free rate. So the 10-year treasury yield, and that's about, I think, 4.2%, somewhere between 4% and 4%. I can't remember off the top of my head. And so right now, Strike is trading at a 400 basis point credit spread, a 370 basis point credit spread. That means its yield is almost double that of the 10-year risk-free rate. And for a typical junk bond like this would be the lowest junk bond rating for any sort of fixed income instrument to have this high yield. So what you're betting is that these instruments are actually much more creditworthy than the market's pricing them as right now. And as people kind of adopt and accept Bitcoin and understand strategy, that they will reprice, and the principal will increase while the coupon decreases.
Gotcha. Okay. All right. Interesting. And I've kind of thought about it as well, where if you have some access to kind of cheaper capital, maybe cheaper debt, you could even do just like a real simple basis trade.
Yeah, totally.
Like you could take out a loan at say 6%, 7%, and you get an effective yield at 8% if the prices were right and all that stuff, right?
Especially for non-recourse debt. I mean, that's a fantastic idea. Yeah.
Yeah, and then participate in that potential upside as well. So you're playing both. Yeah. Incredible. So okay, so let's if you don't mind, we'll we'll move up on the capital stack here. Um, Stride. So you talked about Stride being a having the benefit from the issuance of the instruments below it, and acquiring Bitcoin.
Yeah,
Oh, sorry,
Strife.
Strife, not Stride. Yeah, it gets all confusing here with this STR
I
things.
know they didn't make it easy on us.
So yeah, one part of it is benefiting from the accumulation of Bitcoin or assets from the issuance of the lower on the capital stack equities. What other parts about Strife are interesting to you?
The way they framed it in the Q1 earnings call was it's the crown jewel of the capital stack, and they're clearly moving away from convertible note issuance. And I expect there will be a point in the future where convertible debt isn't something they hold as a part of their balance sheet, and so Strife will be at the top of the capital structure. And you can see this difference by the ATMs that are put on both Strife and Strike. So Strife again at the top of the capital stack. There's only a $2.1 billion ATM on Strife, whereas on Strike there's a $21 billion ATM. Why is that important? They're essentially signaling to the market, We will not be issuing a lot of this Strife. It will be at the top of the capital stack. It will be our most creditworthy instrument, and there will be lots of junior credit instruments that only reinforce the creditworthiness of our crown jewel, investment grade preferred equity. So I've talked to a lot of people, and they think over a long enough time period, Strife's coupon will trade through the U.S. 10-year, and I mean that means essentially it will trade up in value while the yield trades down below that of the U.S. risk-free rate. That's just because of how significantly how over collateralized it is by the Bitcoin on Strategy's balance sheet. So if you believe Josh Mandel made a post about this, or just coined the term. He said, if you think Fidelity is money good, and you think Bitcoin's money, or if you believe in the creditworthiness of Fidelity and Bitcoin, then Strife is money good. Meaning, in all scenarios, as long as Strategy has that Bitcoin, it's a publicly traded company, the reserves are audited, then you will get paid out no matter what on your Strife holdings, going into the future, because it's backed by so over collateralized by Bitcoin.
So the trade or the position, if somebody was to hold Strife, and there we go, it would be because they want the effective 10% at the liquidation preference, or they also believe that the perceived creditworthiness of MSTR will change, and therefore the price of Strife will increase as well.
Exactly.
Okay.
Exactly.
And that could just happen over time of them acquiring more assets. It could happen from the more legitimacy of Bitcoin in the traditional markets. And it could happen from, I think it was the last earnings call. There was a big drive of getting these things rated from credit rated. So that could also potentially create more creditworthiness and therefore a price appreciation.
Yeah, exactly. All those points.
Interesting. Okay. And that was really interesting that you also mentioned the convertible bonds, how you think they'll actually get rid of those. And I think I wondered that myself as well, because they haven't been proactively doing those. And I think it seemed to me like it was a lot of work to create those. And there's this idea of sort of having to refinance the debt when it comes due, which creates a lot of work, and there's extra cost to that. Um, when I first got into MSTR, there was a lot of talk about the convertible bonds, and it seemed like such a great way. Like when you just look at it at face value, oh, there's a 0% coupon on these things. They're just getting all this free money. They're buying Bitcoin with it immediately. But you kind of look beyond the curtain a little bit, and you realize the people buying these aren't on the same side as MSTR. They're a large portion of them are convertible arb traders that pile on shorts to become delta neutral and things like that. Um, is that why you think maybe they're not? So, okay. So I guess there's two questions. Is it because they want Strife to be higher up on the capital stack, or is it also because they realize that the convertible bond scene is just not really for them, and there's this sort of the holders of it aren't necessarily on the same side as MSTR?
I think you hit the nail on the head. Exactly. Yeah, the holders aren't on the same side as MSTR, and they get really, really favorable terms. Like you essentially get a claim over the assets of the corporation, and you get to buy the stock at 30% above the current traded value as a convertible note holder. And what I've learned through Richard Byworth's podcast and his talking is that they don't even need the money up front. They can just borrow the money. They can borrow 100% of the funds from these big institutions, buy the fixed income instruments, and then delta hedge them to all hell, which creates really, really reduced volatility in the stock, right? Because the way that works, that's a really interesting one. And it took me a while. Like everyone says delta hedge, it's like, oh, haha, they just delta hedge, like whatever. No, they actually make money doing this, and they make money no matter how they make money when the stock goes down. That's the key point. Is so what these instruments tend to be about 50 delta, meaning that if the stock moves 100% up, this is right at their issuance. If the stock moves 100% up, those instruments will move 50% up. So they have 50% exposure to the movements in the underlying stock. Now, when the strike when a convertible note is issued is 30 to 50% above the current price of MSTR. If MSTR goes down, the delta decreases. So you only have, so right at the beginning, it's 50% exposure to the price movement of MSTR. Then as the price of MSTR goes down, it's 40% price exposure to MSTR. And eventually you hit a bond floor where if MSTR moves, the strike price is so far away that the price of the instrument, the fixed income instrument, doesn't even move. So what that creates is this ability for them to go short the stock with 50% of the value of the convert note right when they're issued. Then when the stock decreases in value, they can buy back some of their short for a profit, but they still have no price exposure to the equity. But then if the equity goes up, it goes up to above the strike of the convertible note. They short more. They short 60% of the value of the convertible note, and then it goes back down. They buy back some of their short and make another profit. So it's tough to do unless you do it out on paper and look at it. But essentially, every time the stock goes up, these convertible note arb hedgers are shorting more of the stock. Then when it goes down, they decrease their short position. They buy back their short position, which keeps the stock from going up too much and going down too much. So that clamps down on the volatility of the equity, and it's not good. It's not what the options traders want on the public or on the common equity.
Right. Okay. So that 60% you said when it trades higher, that was just like sort of just a number, like an estimate number, and that was based off the delta.
Exactly.
Okay. So yeah, and then it lowers volatility, which the volatility is kind of the reason that those convertible bonds are so valuable as well, right?
Exactly. Yeah.
Because that's what they're doing is they're trading the volatility, but they're also getting rid of the volatility by doing that.
Yeah, that's the problem, right? So that's kind of it kills itself. It's kind of eating itself.
Yeah. What are your thoughts on, we've now moved on beyond the capital stack here. What are your thoughts on something like Misty? Because that's kind of a similar, not similar, but like there's some sort of, there's volatility. They're harvesting the volatility, people say, right? But they're also big player in the options market. What is their effect on the volatility of the underlying? Do you think that affects the underlying volatility stock?
Yeah, I think it does. I mean, just any option seller in the market affects the underlying. If you're selling vol, if you're selling vol, there's going to be less. There's going to be less premium in the options market. At least it doesn't necessarily mean. Well, yeah, it does mean the vol will decrease as well for the same reason. So when you sell a call option, so if for anyone who doesn't know what a call option is, it's the right to purchase the underlying shares and you get paid a premium for that. So when I sell a call option, I'm giving someone the right to buy my shares at a price that's higher than they are now. So MSTR is trading at 390. I can sell you a 450 call expiring in 2 weeks. It means if any time between now and 2 weeks from now, MSTR trades above 450, you have the right to buy my shares at 450. And you paid me a premium for that. So what happens is people go out and sell calls. So I would sell this right to buy my shares at 450 to an options broker dealer. And when they buy that call from me, they paid me that call. They pay me the premium. They bought the call. They then go out and hedge it, so they're not exposed to the movements of MSTR. And that hedging is the exact same thing that happens with the converts. So they're delta hedged on that call. And again, that reduces as the shorts are increased and decreased, that reduces the volatility. So call selling is the same as a convertible note in that it reduces the volatility. So to your point, the more misty there is, the less volatility in the stock. But those things unwind. So like unlike the converts, um, all the calls when you get blown out enough, if you're selling calls, so someone like Misty, if their call strikes are blown through and they're unhedged, they're going to have to buy back and cover those short positions. So the call thing just makes it such that when MSTR moves, and we've seen this in the behavior of the equity, when it moves, it tends to run very hard for a short period of time, and that's because there's a lot of unwind in the short vol trade that goes on. But then there's periods of extreme kind of ranging, and that happens because everyone is capping their upside and downside and reducing the volatility. So I don't think it's a bad thing in the long term, but it just makes it such that you get those explosive price movements. It's something like Misty, that's what it does.
So if Misty was to sell a call that and then MSTR runs up and goes beyond the strike price, you're saying that when Misty has to cover that call and buy those shares to fulfill that call option, that it's creating additional volatility in the common when it has to buy those shares and deliver them?
It's creating like a gamma. You would call it a gamma squeeze. So like take it to the extreme, right? Like let's say you had a stock and there were, let's say you had MSTR and there's only one person. There's only one player in the options market, or there's two players. There are two players. And the one person owned all the MSTR and sold calls against, or sorry, one person owns all the MSTR, and then the other player sells naked calls to someone else on MSTR. So when you sell a naked call, you're unhedged. So they sell 450 calls to someone else. If MSTR were to run to 500, they would get very scared and have to cover their position. They'd have to cover their position as it's moving against them. And so to cover it, to hedge that position, they'd have to either buy back the calls or they'd have to buy the underlying shares to hedge their position. And what does that create? It creates buy pressure. Whereas selling the calls into the market. So when you're buying calls, you're creating buy pressure in the equity. When you're selling calls, you're creating sell pressure in the equity because every call you sell, a broker dealer or a delta neutral trader is selling the equity short to match that delta that they just bought.
And would you consider this, because MSTY does like a poor man's covered call? Its long exposure is like a long options. Would you consider that like selling naked covered? I mean, it's not necessarily selling naked covered calls. It has that sort of synthetic long position, but they still have to sort of move some positions around to if the underlying does go up, right? So maybe there's a more extreme reaction from a fund that is doing a synthetic covered call as opposed to just a traditional one.
Yeah, completely. If they have any unhedged positions, I don't keep track of their positions that much, but if any unhedged positions causes friction, but then even positions that are hedged, as those positions start to lose them money, I mean, they'll probably buy them back. They may buy them back. There's all kinds of things they can do. I'm actually not a big. If you look at the OI on the entire options market for like this Friday's expiration relative to the calls sold on Misty, it's completely two different magnitudes. So like there's a ton of call selling um, and options activity going on outside of Misty. So I don't think Misty is like ruining the stock like a lot of people say.
Right. Okay. Yeah. And so it's more about whether it's hedged or unhedged, kind of is
Yeah,
kind
and
of
it's more about there's probably some hedge fund somewhere with a bazillion gazillion dollars that just sold at the money covered calls against their entire position, and they're collecting all that premium. They've probably hedged it with a different, maybe they're long MSTR, long IBIT, and then short calls at the money on MSTR, and that's like what they believe to be a risk free trade because they want to be short MSTR and long IBIT. So like there's just a million ways in which like people can construct these short vol trades, and I just don't think MSTY is the one that's like crushing the ball.
sure. Yeah, that makes sense. I mean, even in the presentation last earnings call, there was that sort of model trade there of just selling monthly at the money calls and rolling them every month and just getting premium from it. And it was like 100% or something like that return from doing that with MSTR.
I think a lot of people are doing that exactly, and that's cool. And I mean that's why the vol compresses and then it unwinds to the upside, and then it compresses and it unwinds to the upside, and that's kind of how it goes.
All right. Well, yeah, we're coming close to an hour here. I don't know. Is there anything else that we haven't talked about that you think is noteworthy about MSTR, about your story, about any other products, anything we haven't touched on that you think would be interesting to talk about?
I'm by no means an expert on these other LBEs, leveraged Bitcoin equities, but I think it's someone talked to me today about it. But there's going to be a lot of different Bitcoin treasury strategies, and right now everyone's kind of lumping them into this one thing. But there's going to be companies that are private and hold Bitcoin on their balance sheet. There's going to be companies that are like Tesla and just hold some Bitcoin on their balance sheet. Not every company is going to become a financial services provider on top of Bitcoin, and that's kind of what strategy has become, and what looks to be what Metaplan will become. And there will probably be some others, and I think that's okay. And people are going to not understand how to value those different things. And so, therefore, I think strategy should be valued at their treasury operations being their, quite frankly, their preferred issuance. I don't think ATM is like a real long term business. I think the ATM, the equity issuance, I don't know how or why, but I think it will become less and less popular over time. So if you're a Bitcoin treasury company, your one goal should be thinking about how to monetize your Bitcoin stack in a way you see fit, or creating some sort of product in a new market that will create sustainable Bitcoin yield into the next 5, 10 years. And so the game is a long-term game, and most people aren't thinking long-term about their strategy. So for traders, obviously you catch that high Bitcoin yield at the beginning, you make a lot of money. But in terms of looking 5 years out, if you want your company to still be around, you have to And there's no shame, nothing wrong with just being levered long Bitcoin on the balance sheet and having an operating business. And I think that's where most of this should and will go. And then but then also creating those financial products, you have to have a significant stack of Bitcoin. So that's where I kind of think strategy falls in or has a role.
Yeah, that makes sense. And I think you're right. There's going to be a lot of different ways that this looks for companies. And my personal opinion is that every company will become a Bitcoin treasury company, and it'll just be part of their either a small or large or all part of their treasury position, and they'll just have regular operating income and roll it into Bitcoin. I know multiple private businesses that do exactly that. Everything extra they just put into Bitcoin, and it preserves their purchasing power. It allows them to have a longer run rate. It's Bitcoin. Like, it's better money. It's as simple as that. And then yeah, strategy and some of these LBEs are a little bit different in their style and acquisition, right? It's sort of more about monetizing the Bitcoin, collateralizing it directly or indirectly, and using that to acquire more Bitcoin.
Yeah, no, I think you summed it up perfectly. And it's like companies now, right? Most companies capitalize on treasury bills or treasury notes, but not every company's a bank. Like, it's just different.
Yeah, that's a really good point. Yeah. Awesome, Dan. Well, this was really helpful, educational, and I appreciate your time. You're part of True North, as I said, so you guys do a weekly call every Wednesdays. And where else would you like to direct the viewers? I know you have your own YouTube channel, X. Yeah, now's the time. Just let everybody know where to go to find you.
Cool, thanks. I just mess around on the YouTube. My Twitter is where I keep all the good content, so at Hillery_Dan. And then True North, we do a Wednesday live stream where we try to keep our talk professional, and we just talk about LBs and strategy and Bitcoin and all kinds of nonsense like that. So thanks for watching. I mean, it's great. It's been awesome to be on for us. And yeah.
Again, appreciate it a lot. Thanks, Dan.